10 financial principles that will change how you see money. I'm about to share 10 financial principles that can fundamentally change how you think about money and how you make financial decisions. A fair warning though, some of these ideas may make you uncomfortable because they force you to confront beliefs about wealth that many of us have carried for years, often without realizing it. I've spent a great deal of time studying the psychology of money, why intelligent people still make poor financial choices, why many individuals remain broke even after major opportunities, and why truly wealthy people often look nothing like what we expect. If you've ever felt that you're working harder than ever but your finances aren't improving, or if financial success always feels just out of reach, this video is for you. We're going to decode the mental operating system that governs every dollar you earn, save, or lose. What most financial advice gets wrong. Much of traditional financial advice assumes that people make decisions based purely on logic. In reality, that's not how humans operate. Our financial behavior is shaped by emotions, past experiences, family upbringing, and psychological patterns formed early in life. Today, we'll examine these patterns directly and learn how to work with your psychology rather than fight against it. Principle 1. No one is truly irrational about money. Financial decisions that seem foolish on the surface often make sense once you understand someone's background. We experience only a tiny fraction of the overall economy, yet that limited view forms the foundation of our beliefs about money. Growing up during economic crises, greater fear of risk. Coming of age in strong markets, higher risk tolerance. Family conflict over money, either extreme frugality or complete avoidance. Once you understand this, you stop judging others and start examining your own financial behavior. Principle 2. Defining enough is more important than you think. The problem isn't a lack of ambition, it's never deciding where to stop. Without a clear definition of enough, you will constantly raise your standard of living, continuously move your financial goals, and rarely feel satisfied. Many people sacrifice health, time, and relationships to chase things they don't truly need. Sustainable wealth is built by those who earn the most, but by those who know when to protect what they already have. Principle 3. Compounding requires patience, not genius. Building wealth doesn't require constant brilliant decisions. It requires starting early, being consistent, and remaining patient. Small amounts invested regularly over long periods often outperform large, irregular investments. It sounds simple, but it's difficult precisely because it's boring. Principle 4. Always prepare for the worst-case scenario. Every financial plan will face setbacks. An emergency fund won't make you rich, but it prevents costly mistakes, keeps you from selling assets at the wrong time, and gives you control when life takes an unexpected turn. Smart people don't optimize for the best-case scenario. They build systems that won't collapse when things go wrong. Principle 5. Good money management looks ordinary. People who succeed long-term usually don't chase trends, don't panic during market volatility, and stick to simple strategies. This consistency may not attract attention, but it's one of the most reliable paths to wealth. Principle 6. The ultimate goal isn't money, it's choice. Money matters most when it provides flexibility, the ability to say no, and freedom to choose how you live. High income paired with high fixed expenses can trap you. Living simply often provides more options when circumstances change. Principle 7. Others care less about your possessions than you think. We often buy things to signal success, but in reality, people notice the object, not the owner, and imagine themselves owning it. True wealth is usually invisible. Principle 8. Savings matter more than income. Income is only the starting point. What truly matters is how much you keep. Every dollar not spent today has the potential to grow over many years. Principle 9. Staying invested matters more than perfect timing. The longer your investment horizon, the lower your risk. Trying to time the market often leads investors to buy high, sell low. Patience, not prediction, creates the biggest advantage. Principle 10. Volatility is the price of long-term returns. Market volatility is not a sign of failure, it's a condition of growth. Those who refuse to accept it often pay a higher price by missing long-term opportunities. Conclusion. Money is more about psychology than numbers. People who manage emotions, maintain discipline, and stay patient not only build more wealth, they experience greater peace of mind. If these principles made you rethink your perspective, that's a good sign, because once your mindset around money changes, your future decisions will change with it.